If you are holding silver right now and feeling that tightening pressure in your chest as you watch the price sit at $74, or if you were preparing to enter the market but froze when the crash accelerated, you need to stay focused for the next several minutes, because what is unfolding in February 2026 may ultimately be remembered as one of the most strategically misunderstood moments in modern commodity history. Today is Wednesday, February 18th, 2026, and the emotional climate surrounding silver is overwhelmingly negative. Commentators are calling the rally finished. Financial television panels are warning viewers to avoid the metal. Social platforms are crowded with frustration, disbelief, and capitulation. But markets rarely reward emotion. And beneath this wave of fear, institutional behavior is moving in a direction that tells a very different story. Silver reached $120 per ounce in January before entering a brutal liquidation phase. In a matter of weeks, nearly 40% of its value evaporated as paper markets experienced aggressive selling. The spot price now trades around $74. 18 months ago, that level would have been viewed as astonishingly high. Today, it feels catastrophic to those who bought near the peak. This contrast between historical context and present emotion is important. Price levels do not exist in isolation. They exist within narratives, and the dominant narrative right now is decisively bearish. However, on February 11, 2026, J.P. Morgan Global Research released an updated commodity outlook that quietly contradicted that narrative. In that report, the bank projected that silver would average $81 per ounce for the full year of 2026. To appreciate the significance of that projection, you have to compare it to 2025, when the average silver price was materially lower. An $81 average would represent more than a doubling relative to the prior year's average price. The report extended further, indicating that silver could approach $85 per ounce by the fourth quarter of 2026, as structural supply deficits continue tightening the physical market. This creates a critical question. If one of the largest and most data-intensive bullion institutions on the planet expects silver to average $81 this year and potentially rise to $85 by year-end, why is public commentary so aggressively bearish at $74? Why are retail participants being warned away from an asset that the bank's own forward projection suggests is currently trading below its expected annual mean? To answer that, you must understand J.P. Morgan's operational position inside the silver market. This is not simply a research house offering opinions. J.P. Morgan is the largest custodian of physical silver on the COMEX exchange, the primary futures venue for precious metals in the United States. COMEX, operated by CME Group in New York, maintains a network of approved vaults where metal is stored to support futures contracts. The silver held in those vaults is classified as either eligible or registered. Eligible silver satisfies the exchange's weight and purity requirements and is stored in approved facilities, but it is privately owned and not automatically available for delivery. Registered silver, by contrast, is specifically warranted and designated for delivery against futures contracts. It is the pool of metal that can actually change hands when a contract holder demands physical settlement. The distinction matters because registered inventory represents the immediately accessible supply backing paper claims. On February 11, 2026, CME Depository Statistics confirmed that total registered silver inventory had fallen below 100 million ounces. The reported figure stood at 98.1 million ounces. Only a few years earlier, registered levels exceeded 150 million ounces. The reduction was not sudden. It resulted from a multi-year pattern of metal leaving the vault system. That outflow accelerated during 2025 and into early 2026 as industrial users and long-term holders increasingly prioritized physical possession over paper exposure. Delivery reports add another layer of significance. During specific weekly delivery cycles in early February 2026, J.P. Morgan accounted for nearly 99% of all physical silver deliveries processed through COMEX. At the same time that public commentary leaned cautious and highlighted volatility, delivery desks were actively moving substantial volumes of metal. These figures are not speculative. They are drawn directly from publicly accessible exchange reports. This dynamic resembles what seasoned traders call a head fake. In trading terms, a head fake is a maneuver that encourages participants to believe a trend has reversed, prompting them to exit positions prematurely before the underlying trajectory resumes. In the current environment, paper selling and bearish messaging have driven visible prices sharply lower, while physical inventory continues to be redistributed. JP Morgan's historical record in precious metals markets reinforces the need for scrutiny. In September 2020, the United States Department of Justice secured a guilty plea from JP Morgan for spoofing activity in precious metals futures markets. Spoofing involves placing large orders with the intention of canceling them before execution to create artificial impressions of supply or demand. The bank paid more than $920 million in penalties under a deferred prosecution agreement. Several traders faced criminal charges and convictions. While that episode does not automatically imply identical actions today, it establishes precedent and context for evaluating current behavior. Beyond institutional positioning, the structural argument for higher silver prices rests on persistent supply deficits. According to data from the Silver Institute, the global silver market has operated in deficit every year since 2021. A deficit means total global demand exceeds total mine production plus recycling. These imbalances have been substantial rather than marginal. Projections for 2026 estimate a shortfall of approximately 67 million ounces. If realized, 2026 would mark the sixth consecutive year of deficit, a historically rare streak in modern silver markets. Understanding why deficits persist requires examining silver's supply structure. Roughly 80% of global silver output originates as a byproduct of mining other metals, such as copper, lead, zinc, and gold. Silver production, therefore, depends largely on the economics of those primary metals rather than silver's own price. If copper output declines, silver supply falls regardless of silver's market value. Economists describe this characteristic as inelastic supply, meaning production does not quickly respond to price incentives. Primary silver miners contribute only about 20% of global supply and cannot rapidly scale output to close a 67 million ounce annual gap. Developing new mines involves exploration, permitting, environmental reviews, infrastructure development, and capital deployment that typically require 7 to 10 years. Even aggressive expansion efforts today would not materially affect supply until the early 2030s. This combination of declining registered inventories, concentrated delivery participation, documented institutional forecasts, and persistent structural deficits forms the foundation of the current silver narrative. It is against this backdrop that the demand side of the equation becomes even more significant. On the demand side, the transformation underway in the global economy is embedding silver into systems that cannot easily function without it. Industrial fabrication now accounts for more than half of annual silver consumption worldwide, and that share continues to expand. The most visible driver is solar energy. China remains the dominant force in photovoltaic panel manufacturing, scaling production capacity aggressively as part of its broader strategy to lead the global energy transition. The International Energy Agency continues projecting double-digit annual growth in solar installations through the end of the decade. Every solar panel relies on silver paste to conduct electrical current across photovoltaic cells. While manufacturers pursue thrifting strategies designed to reduce the amount of silver per panel, overall installation growth is outpacing those efficiency gains. JP Morgan's own analysis acknowledges that thrifting will be gradual and that near-term demand growth remains intact due to sheer scale. Beyond solar energy, artificial intelligence infrastructure has become a powerful new source of silver demand. The data centers supporting machine learning, cloud processing, and advanced computing require enormous quantities of electronic components built for speed and reliability. Silver's unmatched electrical conductivity makes it critical in connectors, printed circuit boards, switches, and thermal interface materials. Industry estimates indicate that AI-related hardware and the broader data center build-out are consuming approximately 235 million ounces of silver annually. That figure alone underscores the scale of industrial usage compared to historical periods. Simultaneously, the global rollout of 5G telecommunications infrastructure continues. Fifth-generation wireless networks require silver within antenna arrays, filters, and switching modules capable of handling higher frequencies and faster data throughput. Telecommunications expansion across developed and emerging economies adds steady demand that does not depend on investor enthusiasm. Electric vehicles provide another incremental layer. Each battery electric vehicle contains roughly 1 to 2 ounces of silver within electrical contacts, battery management systems, and onboard control circuitry. As adoption increases across China, the European Union, and the United States, this source of consumption is projected to rise consistently through the remainder of the decade. When solar, artificial intelligence infrastructure, 5G deployment, and electric vehicle manufacturing are considered together, silver's demand profile looks fundamentally different from previous cycles. Earlier bull markets were often driven primarily by investment demand and macroeconomic speculation. In contrast, 2026 demand is rooted in industrial necessity. Factories and technology platforms require silver as a functional material, not as a speculative asset. This structural shift reinforces the supply deficit narrative and aligns with projections such as JP Morgan's $81 annual average and potential $85 fourth quarter target. Evidence of physical tightness is also visible outside Western markets. The Shanghai Gold Exchange, despite its name, serves as a major hub for physical silver trading. During the recent correction from $120 to $74, premiums on the Shanghai Exchange remained elevated. The Shanghai Silver Premium represents the difference between local exchange prices and benchmark prices quoted in London or New York. Historically, this premium hovered in low single-digit percentages, reflecting normal transportation and import costs. Recently, however, the premium has widened, indicating that Chinese buyers are willing to pay above Western spot prices to secure actual physical metal. This divergence between paper prices and physical premiums is often described as physical decoupling. It occurs when futures-derived spot prices no longer accurately reflect the real-world cost of acquiring metal. When the quoted paper price declines sharply, but physical buyers continue paying elevated premiums, it suggests that futures market dynamics rather than genuine supply-demand balance may be influencing visible pricing. Historically, sustained divergence has tended to resolve with paper prices moving upward toward physical reality rather than physical markets collapsing to match paper weakness. The structure of the COMEX futures market helps explain how this dynamic can persist. In most delivery months, less than 5% of open silver futures contracts result in actual physical settlement. The vast majority are closed out before delivery windows open. This means that the globally quoted silver price is heavily influenced by leveraged speculators, algorithmic traders, and institutional desks that never intend to handle physical metal. At times, the ratio of total open interest to registered inventory has approached 350 to 1. In practical terms, that means multiple paper claims exist for each registered ounce available for delivery. The system functions efficiently only as long as most participants accept cash settlement. The decline in registered inventories to 98.1 million ounces heightens sensitivity around major delivery months, such as March 2026. Market observers are closely tracking open interest as that window approaches. If an unusually high percentage of contract holders stand for delivery rather than closing positions, strain could emerge within the available inventory pool. COMEX rules provide mechanisms such as cash settlement alternatives and delivery extensions to prevent outright default. However, even visible logistical stress would undermine confidence in the paper pricing mechanism. Potential delivery tension can create a self-reinforcing cycle. Traders anticipating tight supply may increase delivery requests preemptively. That behavior reduces available inventory further, amplifying concerns and encouraging additional participants to act. Markets often react to expectations as much as to confirmed shortages. Within this environment, JP Morgan's forecast gains additional significance. As the largest custodian of COMEX silver, the institution has direct insight into daily inflows, outflows, and warrant activity. Its projection of an $81 annual average and potential $85 fourth quarter pricing reflects access to granular information unavailable to most retail investors. The broader dynamic, often described as the grand wealth transfer, becomes relevant here. The theory suggests that volatility redistributes assets from weak hands to strong hands. Weak hands typically consist of short-term speculators using leverage who buy into rallies and exit during downturns. Strong hands include institutions, sovereign wealth funds, industrial consumers, and long-term physical holders who view corrections as accumulation opportunities. The rapid decline from $120 to $74 eliminated substantial leveraged exposure. Options expired worthless. Futures positions were liquidated, yet the underlying physical metal did not disappear. Ownership shifted. Historical commodity cycles show that large bull markets frequently include violent corrections that shake out retail participation before longer-term uptrends resume. What differentiates 2026 from previous episodes is the scale and durability of industrial demand. In 2011, silver's rally was heavily influenced by monetary speculation. Today, demand is embedded within infrastructure that cannot easily pause production. Data centers require conductive materials. Solar farms require silver paste. Electric vehicles require reliable circuitry. This industrial base strengthens the structural deficit thesis. Even if investment demand temporarily cooled, consumption from manufacturing and technology sectors would continue drawing from limited supply. The imbalance between production and usage remains a defining feature of the market. Macroeconomic narratives surrounding Federal Reserve leadership changes and dollar strength add short-term volatility, but do not eliminate underlying deficits. Monetary policy decisions require consensus within the Federal Open Market Committee. Elevated government debt exceeding $36 trillion constrains aggressive tightening. Currency cycles historically fluctuate, and initial reactions to leadership nominations often moderate over time. For physical silver holders, price swings have different implications than for leveraged traders. A bar or coin remains tangible regardless of daily price movements. Losses are realized primarily by those employing leverage or short-dated derivatives. This distinction underscores the structural advantage of patient ownership over speculative exposure. As March approaches, market participants will monitor delivery data carefully. Regardless of immediate outcomes, the supply-demand imbalance continues shaping the broader trajectory. Industrial consumption, constrained mine output, and declining registered inventories remain central to the silver narrative. The tightening picture becomes even more compelling when you widen the lens beyond COMEX and examine global above-ground inventories tracked by independent data sources. According to the Silver Institute, identifiable silver holdings across exchange-traded funds, exchange vaults, and other monitored repositories have been trending lower even as prices climb significantly from their 2020 lows. In a conventional commodity cycle, rising prices typically encourage holders to liquidate supply back into the market. Higher prices are supposed to unlock metal from private storage, yet silver has behaved differently. Much of the metal removed from circulation over the past several years has not returned, even during the rally to $120. This phenomenon is often described as sticky supply. Once silver transitions from circulating inventory into long-term private ownership, it does not readily re-enter the market merely because the price fluctuates. When sticky above-ground supply intersects with inelastic mine production and expanding industrial consumption, the result is cumulative pressure. The world continues consuming more silver annually than it produces. That difference must be covered by drawing down existing stockpiles. As those stockpiles shrink, flexibility diminishes. Markets can obscure imbalance temporarily through paper trading, but physical arithmetic remains unforgiving over extended periods. The sharp drop from $120 in January to $74 by mid-February 2026 has been described by some market participants as a purge. Instead of a prolonged correction that erodes confidence slowly, the market experienced a rapid and dramatic adjustment. Fast declines often force emotional decisions. Leverage positions are liquidated. Margin calls accelerate selling. Retail traders who entered near the highs capitulate under pressure. This sequence is not unusual in commodity markets. What matters is what happens after forced selling exhausts itself. Experienced traders sometimes refer to such episodes as liquidity events. Panic creates opportunity for well-capitalized participants to accumulate at discounted levels. Whether $74 ultimately proves to be the precise bottom is unknowable. Markets rarely provide perfect clarity at turning points. However, when institutional projections indicate an $81 annual average and potential movement toward $85 by the fourth quarter, current pricing appears inconsistent with medium-term expectations. Attention now turns toward the March 2026 COMEX delivery cycle. March is traditionally a significant settlement month for silver contracts. Market observers are monitoring open interest closely to evaluate how many participants may choose physical delivery rather than cash settlement. If delivery requests exceed routine levels, even modest logistical strain could alter market psychology. COMEX possesses mechanisms to manage settlement pressures, including cash alternatives and scheduling flexibility, but visible tightness would challenge confidence in paper pricing mechanisms. Even without dramatic headlines, incremental evidence of tightening can influence positioning. Traders adjust expectations based on subtle shifts in inventory levels and warrant activity. Markets often respond preemptively to anticipated constraints rather than waiting for formal shortages. Industrial drivers continue advancing regardless of short-term price movements. Solar capacity additions remain strong. Artificial intelligence infrastructure investment continues expanding as technology companies commit substantial capital to data center growth. Telecommunications upgrades progress. Electric vehicle production increases across major economies. Each of these sectors embeds silver within operational systems. The demand does not disappear because futures prices fluctuate. Silver's fundamental properties reinforce its strategic importance. As element number 47 on the periodic table, silver possesses unmatched electrical conductivity along with excellent thermal conductivity and reflectivity. These characteristics make it exceptionally valuable in high-performance electronics and renewable energy systems. Substitutes often compromise efficiency or durability. While engineers can reduce usage through innovation, complete replacement remains impractical in many applications. Scientific reality underpins long-term demand. Macroeconomic considerations further complicate the narrative. Government debt levels exceeding $36 trillion constrain aggressive monetary tightening. Structural fiscal deficits persist. Federal Reserve leadership changes may trigger short-term currency strength, but policy decisions require consensus and must account for broader economic stability. History demonstrates that markets frequently overreact initially to leadership transitions before settling into more balanced expectations. As currency cycles evolve, precious metals often regain support as stores of value. For individuals holding physical silver, the distinction between paper valuation and tangible ownership remains central. A coin or bar stored securely retains intrinsic properties independent of derivative markets. Short-term price volatility affects sentiment but does not alter the physical asset itself. Historically, precious metals have served as hedges during periods of monetary uncertainty and structural imbalance. The narrative declaring silver's rally finished overlooks the broader framework. From 2020 through early 2026, silver experienced significant appreciation before the recent correction. Markets rarely move linearly. Corrections are common within larger trends. The crucial issue is whether underlying supply-demand drivers have shifted materially. In silver's case, persistent deficits, constrained mine supply, and expanding industrial consumption remain intact. The concept of a wealth transfer captures how volatility redistributes ownership. Those lacking conviction or using leverage often exit positions during downturns. Institutions and long-term holders accumulate. This process repeats across asset classes and market cycles. In a tightening physical market, the consequences of redistribution may be amplified. Delivery data showing concentrated institutional participation underscores the contrast between public messaging and operational behavior. When research divisions project higher averages while delivery desks process substantial volumes, observers must consider the possibility that surface narratives do not reflect deeper positioning. Looking ahead, the interplay of declining registered inventories, a projected 67 million ounce deficit in 2026, and JP Morgan's forecast of an $81 average with potential movement to $85 by the fourth quarter creates a coherent framework. Volatility may persist. Headlines will shift. Yet the arithmetic of consumption exceeding production continues operating beneath daily price swings. As March unfolds and subsequent delivery cycles progress, the market will receive additional data points. Regardless of immediate outcomes, the structural deficit does not vanish. New mines cannot be developed overnight. Industrial systems cannot eliminate silver dependency instantly. The imbalance between available supply and required consumption remains embedded within the global economy. The ultimate determinant of price in commodity markets is physical scarcity over time. Paper claims can influence quotations temporarily, but they cannot manufacture additional ounces. Silver remains a finite resource essential to modern infrastructure. As 2026 advances, the tension between paper volatility and physical fundamentals may define the trajectory of this cycle. For those evaluating their strategy, understanding these structural forces provides clarity beyond emotional headlines. The convergence of declining inventories, documented institutional forecasts, and sustained industrial growth suggests that the current price environment represents a chapter within a larger unfolding narrative rather than its conclusion.